What's going on, everybody? Welcome back to another episode of the Trade for Yourself podcast, where my mission here is still very simple. I just want to help you learn how to trade and invest in the stock market for yourself. So make sure that you please like this video, okay? Please like this. Please like this. Please subscribe. This will help me out in the algorithm and help me get this message out to multiple people. So please make sure that you like this and subscribe to the podcast. So look, in today's episode, we are going to talk about Google stock and their earnings preview. Now we are starting to get into earnings season. Okay. We had some banks reporting last week and we had some banks reporting this week. Okay. The market has been reacting to it. We have Netflix reporting tomorrow. We have Procter and Gamble reporting tomorrow. And we're going to have some big tech companies start to report next week and the week after that. And so I wanted to highlight Google because I just want to talk about this company and talk about some of the things that we need to pay attention to. So what are the three things I'm going to be trying to focus on during this episode? Okay. Number one, what is driving the stock right now and what is expected to drive the company in the future? Number two, what are the earnings expectations for the company and some valuation metrics that the company has? And what is the stock chart doing? Okay, what is the price trading at right now? And so I want to put all of this stuff into context so we can think about how good Google is as a company. And so let me go ahead and get started and let me share my screen so we can get started to the first thing that I want to talk about in relation to Google stock, because I think everybody is kind of just getting wrapped up in potentially the wrong thing in terms of Google. And so when you think about Google, what do you think about? You think about the search engine, right? And the search engine in Google is related to Google services. Okay, with the Google services, Google makes about 80 to 85% of their revenue from advertising, right? And so Google has been getting a huge downgrade and the stock has been taking a beating, over the last year or so because of the expected impending recession, right? The expected recession is what has been hurting Google stock, and advertisers have been pulling back advertising spending. But what I feel is that once we get through everything and once everything kind of plays itself out, Google will come back on the other side of that and advertisers will come back because Google is the king of advertising. And so when you think about the situation, when you think about YouTube and you think about Google search and you think about all of the services that Google provides, right? Google is still going to be a king in advertising, and advertising is going to come back. But there are other businesses that Google has that people need to realize, and that is the Google Cloud, the cloud, like the cloud computing infrastructure. Now, Amazon, Microsoft, and Google dominate the cloud market. And so when you think about cloud infrastructure service revenues in the last 12 months ended September 2022, $217 billion was allocated towards cloud infrastructure service revenues. Now, Google Cloud is number three on this list at 11%, behind Microsoft Azure at 21%, and behind Amazon AWS at 34%. However, Google is the fastest growing cloud provider out of the three. Also, right now, Google Cloud is not profitable. Like, they are not profitable in this segment of the business, but I promise you the company is going to become profitable. Google is a cloud business and Google is an AI business. Okay. They are focused on artificial intelligence in everything they do, with Google search, with Gmail, with their Android services, the Google Play. Everything that they have going on is related to the artificial intelligence. Even their other bet segment, when we talk about autonomous driving is artificial intelligence. And so what I want you to understand is that Google is trying to get to a point to where they're using the revenue and the profit that they are generating from the advertising business that is helping to fund their cloud services, that's helping to fund other AI projects that they are working on to compete against Microsoft with ChatGPT and the other bets in terms of autonomous driving and other health technologies, okay, that we are expected to grow over the next 5 to 10 years. And so that's why, even though Google has been beaten down, even though Google is a very popular stock and everybody owns the stock, this is a perfect time to consider adding Google to your portfolio. Okay, like keep that in mind. And so we're talking about the cloud, we're talking about AI. Let's go ahead and go over to the analyst expectations. Okay, what kind of expectations do we have for this company? And so the first thing I wanted to start off with, I wanted to start off with pretty much the median estimate trends. And so this episode, what are we talking about? We're talking about the earnings preview for Google stock. Okay. And so, you know, you've probably been hearing a lot on CNBC and other points in the media to where you keep hearing things like analyst revisions. Okay. What are analyst revisions? Analyst revisions are when analysts that pretty much track the stocks are adjusting what they expect the company to report in terms of earnings per share. Sometimes they revise revisions up, sometimes they revise revisions down. As you get closer to earnings, what tends to happen is that, and what I have seen over the last year covering these stocks and kind of looking at what the analysts are doing, as you get closer to the actual earnings date, more estimates tend to be revised down. Now, if you look at it from the totality from the totality of earnings in general, earnings across the entire stock market has been revised down because of what? Everybody is expecting a recession. And so over the last 120 days, you've seen one broker downgrade over the last 120 days. That's not very bad. Over the last 30 days, you've had one up revision and 4 down revisions. Your average up revision is 2%, but your average down revision is negative 8.2%. Okay. And so let's look at the mean estimate trend. Okay. So I want to look at what are we expecting from the previous quarter. And so right now we're expecting about $1.18 per share. Okay. That's pretty much what we're expecting Google to earn. 30 days ago, we were at about $1.19. 90 days ago, we were at about $1.39. So we're at about a negative 14% change from 90 days ago. And so if you calculate that and you look at the current estimate trend, the current trend in terms of what we expect Google to earn over the year 2022 is about $4.70, which 90 days ago we were expecting $5.11. So things have changed a lot over the last 90 days, right? But the one thing I want to tell you and I want to point out is that Google had a down year, right? Google had a down year in terms of earnings. Okay. In terms of earnings, they had a down year. They regressed in terms of earnings, but they still are forecasted to grow their annual revenue by 10%, right? The reason why they had the downgrade and the downtrend in the earnings is because, let's just face it, Google is heavy advertising, and there's nothing wrong with that. It's just that so many companies pulled out of the not necessarily pulled out of the advertising business, but they were lowering their advertising budgets. But what we know is that whenever economic expansion is going to be coming back, we understand that individuals and businesses are going to be utilizing Google in order to help expand that. And so when we look at the median estimate trend, we're probably going to come down to about $4.70 when we estimate the 2022 earnings are all said and done. But we're expected to have a reacceleration of the growth in earnings for the full year of 2023. And so we're expected to go from the full year of 2022, $4.70 up to $5.15, which is very, very good, right? It's still down over the last 90 days from the $5.84 number, but at the end of the day, it's still growth nonetheless, okay? Because I'm going to give companies like this a little bit of grace because they had so much growth that was pulled forward during the COVID years, okay, during the pandemic. And so These companies, even though they have large market caps and they are mega cap companies, they still have so much growth left in them. They're still investing money into research and development because they want to stay at the top. These companies do not want to let go of their top spot, right? Their balance sheets are too solid. They have too much domination in the market share. And so what they want to do is they want to keep everything going. They want to put the pedal to the metal. Now, the expected earnings report date is going to be February 2nd. Okay, February 2nd is when we're going to be expecting Google to report earnings. We're going to want to pay attention to the earnings report. What is the company going to say? Are they going to comment on the reported layoffs? Are they going to comment on the advertising business? What are they going to be saying, right? What are we going to see the management of the company say in terms of their guidance and what they expect in the landscape in the first quarter of 2023 and the rest of 2023? Now, some fundamental metrics that I want to look at right here at the bottom that I believe are very, very important in terms of looking at a company, right? So revenue growth, 17.9%. Okay, that is very, very good revenue growth, and it's better than their industry average. Gross margin is 56.1%, better than the industry average, which is very, very solid. If you're over 50 to 55% in terms of gross margin, that is great. The return on equity for this company is 26.9% in relation to negative 4.3% as the industry average. Great. Net margin, 23.7%. Okay, so pretty much after Google pays everything off, their net margin is 23.7%. Outstanding. Okay, let's look at the debt over here. The current ratio, 2.5%, better than the 1.7% industry average, which is outstanding. Google has so much cash on their balance sheet. Remember what this current ratio is. The current ratio is comparing the current assets to the current liabilities, which measure what the company is expected to receive over the next 12 months and what the company is expected to pay out over the next 12 months. Okay. Debt to capital, 5.6%, lower than the industry average of 13.6%. And we got interest funding and interest coverage. Now, we see that Google's metrics are pretty much a lot better than what their industry average is. But what I want to put into perspective is that Google is in the communication services sector. And so when you talk about the communication services sector, the communication services sector has so many different companies. You've got Google, you've got Meta, you've got Netflix, but you've also got T-Mobile, you've also got AT&T, you've also got Verizon, you also have telecommunication companies in this industry as well. And so me personally, I take the industry average with a grain of salt because Google isn't, in my opinion, isn't really being compared to most of its peers, right? Okay, I would say that Meta is a peer. Netflix is a peer, right? Those are the only two companies that I believe are really, truly peers. But what are some other peers to Google? Amazon is a peer. Microsoft is a peer. I would argue Tesla is a peer. Apple is a peer, right? I would argue that to a certain degree, Nvidia may be a peer. And so when you think about this, right, think about comparing Google to not just the companies in their sector, right, or the companies in their industry, or think about comparing Google to companies that pretty much swim in the same pond, right? That's pretty much what you got to compare Google to, right? Don't think about comparing Google to a telecommunications company because Google is not a telecommunications company, right? The S&P 500 decided to create the communication services sector, and they decided to take Google from technology to communication services. They decided to take Netflix from technology to communication services. They decided to take Meta from technology to communication services. And so put that into perspective whenever you look at a report and that report and you look at a Google report and Google is pretty much comparing themselves to industry average. Just keep that in mind when you're thinking about that, right? And so let's look at the relative valuation highlights for this company. And so, I really like looking at the forward PE, right? The forward PE, right? Because it's going to tell me what the company is expected to earn over the next 12 months, which pretty much helps me because I want to think and I want to approach the market as the market approaches the market. And what I mean by that is that the market is a forward-looking mechanism. It's always looking forward. It's always pricing things in. And so I want to look at, okay, I understand what Google may have earned last year. What are we expecting them to earn next year? Because last year is over. We're in 2023 now. What is Google expected to earn over the year 2023? And so I love that forward PE metric. And so that forward PE is putting us at 18.8, right? Which is much lower than its own 5-year average. So pretty much Google is at a discount in relation to what it normally trades at over a 5-year period, right? The S&P 500 index is a little bit higher than the S&P 500 index average. But when we think about the S&P 500, we're talking about every single sector, right, in that particular index, right? We think about industry average 23.1. So we're talking about the entire communication services, the entire sector, right, is pretty much what we're talking about. Google is trading at a discount to that. And so, that's very, very good to see, like pretty much seeing the stock trade at a discount to what it normally trades at. I really, truly like seeing that. And so next, what I want to do is I want to look at the chart. Okay. I want to look at the chart and I want to just, make a comparison, right? And when I say make a comparison, I want to take the forward PE metric, okay? Take that forward PE metric, take the forward earnings and establish what a fair value price would be based on those metrics, right? And so when we look at the chart, we see that Google made a high in January of last year and the stock broke down, right? The stock clearly broke down. The stock is clearly in a downtrend. The stock is clearly broken, right? It's clearly broken. But we understand that the company is not broken. The company is still solid. The fundamentals are still solid. Management is still solid. The products and the services that the company provides is still solid, right? It's still very, very solid. It's just the stock is broken because of the environment that we are in, because the stock had just got so much overvalued, right? The revenue was so high, so much growth, so many different reasons for why the stock was so high. But now we're back down to earth, right? And so based on these metrics, right, what I did was I wanted to come up with a fundamental valuation based on the forward PE and the estimate earnings that I have right now. So when you think about that, you're talking about 18.8 multiplied times $5.15, right? $5.15 is the total earnings per share that we are expecting for the year 2023. And I'm multiplying that times the forward PE multiple, 18.8. That gave me the $96.82 as the fair value price. And so that's the fair value price that we're looking at, right? In terms of saying, hey, this is pretty much what Google stock is worth fundamentally, right? And so right now the stock closed at $91.12. So it closed below that fair value price. And so when you look at it, if you're looking at Google and you're deciding, you're saying, hey, should I be investing into Google? I believe right now is a great time because when you make that investment into that company, okay, when you make that investment into that company, remember, this is not financial advice. I am not a fiduciary. You have to think about, do you believe in the company, right? What is your time horizon for this company? Okay, how long do you want this investment to play out? Okay, do you believe in management, right? Do you understand the business? All right. Do you understand the business? Do you understand the growth trajectories that the company has for it, really truly coming up, right? Do you believe that Google is going to become a profitable cloud provider? Like, do you believe that? Do you believe that Google is still going to be a leading advertising company, right? Do you believe in their investments in the podcast community in terms with YouTube and things of that nature? Do you believe in their health technology bets and their autonomous driving bets and other AI technology bets to compete against their peers like Apple and Microsoft and Amazon and all of that? Do you believe in that, right? Do you believe in that? If you believe in that, purchasing this stock at $91.12 below a fair value price that I believe is good may be good for you. And also, I also like to put in the 10% discounts and 20% discounts. A 10% discount would be $87.14. A 20% discount will be $77.46. So when you look at all of that situation, right? This $77.46 valuation measures right up with the previous all-time high for the stock before COVID, right? We're getting back into technical trends for a lot of stocks to where now we have to compare their stock prices in relation to where they were pre-COVID. Okay. Like, obviously, that $77.46 represents a pretty strong support, in my opinion, for the stock. It represents a pretty strong support because I don't see it going down to where it was at the bottom of COVID. I don't really see that happening. But I do see a possibility of it coming down to pretty much obtain this 20% discount of $77.46. We do have some bearishness in the market that can happen. It's at $91.12 right now. It could easily come back down to $87.14 and come back into some support, because it found support down here with that 52-week low of $83.34. It found some support there. And so can the stock come back down to where it was, late last year? 100%. I think that what we should do is and this is what I always like to tell people. If we believe in the company, we should use this as an opportunity to build a position. You don't, if you have $5,000 to invest, you don't have to put $5,000 to work at one time. Put a little bit to work at a time, a little bit at a time, build that position and have a strong position with a strong average price, right? Because I'm telling you, you really want to build this position as the stock is beginning to base out, because I believe the stock is going to begin to base out, and we're going to get back into an accumulation state to where smart money is going to be accumulating shares of this stock when this stock is so low. And so you want to already have built the position when the stock is low, so you can put yourself into a position to where you probably won't have to buy the stock again, right? But again, as you're building wealth, it takes time, right? We're not going to get rich. We're not going to build wealth overnight, but understanding the research and doing all the things and, utilizing the tools that we need to utilize, that's going to help us moving forward. And so again, I thank you all for coming back to another episode of the Trade for Yourself podcast. Please make sure you like this. Please make sure that you subscribe to this. Okay, please tell me this. Tell me, what are you expecting from Google's upcoming earnings? Do you expect them to report well? Are you thinking about investing into this company? Because I think that Google has a lot of good prospects that we need to pay attention to, and that if you really truly want to be a part of this company, now is the time for you to be doing the research and executing on the position. Okay, remember, don't pay for it, trade for it. I'm gonna tap in with y'all next time.